Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Polito. This week, Mark Wiedman, head of BlackRock's global client business, will guest host 3 episodes on The Bid as part of a special miniseries focusing on infrastructure. Mark will lead conversations with investors from global infrastructure partners who are now a part of BlackRock to discuss investing insights in the world of infrastructure and how private capital will be key to the growing need for investment in the infrastructure landscape.
Earlier this year, BlackRock announced plans to acquire Global Infrastructure Partners, or GIP, a leader in infrastructure investing. Infrastructure sits at the heart of the world's biggest structural forces: the transition to a low-carbon economy, advancements in AI, and the urgent need to repair aging infrastructure, roads, bridges, and airports. With governments everywhere facing budget constraints, private capital is critical to filling that gap.
Most infrastructure assets, they really haven't been put through the rigor of what you would normally see in an industrial company. And that brings a completely different mindset of managing that asset and improving the operational capability of that, hence ultimately improving profitability.
In this first episode of our infrastructure mini-series on The Bid, I'm joined by Raj Rao, President and Chief Operating Officer of GIP, now a part of BlackRock, to talk Infrastructure Investing 101, how the asset class started, what's driving its growth, and why it's becoming a must-have in investors' portfolios. Raj Rao, welcome to The Bid.
Thank you, Mark, for inviting me to the bid.
Raj, what is infrastructure?
Infrastructure is assets that touches everyone's life on a day-to-day basis. And sometimes you see them and sometimes you don't. So these are airports, ports, rail, power, pipelines, renewables, data centers, telecom towers, water and waste facilities. So you know what it is. But hey, how does electricity come to your house? Why is the heating in your house work? Because there is some pipeline somewhere that has transported gas to a facility that heats up your home.
Who owns infrastructure?
Most of the infrastructure in the world is owned by governments, federal or state. I would say 80 to 85% of the infrastructure in the world is owned by governments. 20% is in private hands. Most of it is in hands of corporates, because some of the biggest oil and gas companies, utilities in the world, transport companies in the world, digital companies in the world own a lot of infrastructure. And over the last 18 years, which is when we started GIP, the infrastructure as an asset class in the private alternative world has grown rapidly. So now a big part of infrastructure sits with funds like ours that own really large critical assets all over the world.
What's the logic for infrastructure sitting in private hands?
The logic for infrastructure sitting in private hands is that it can be managed better, because if you think about infrastructure assets, some of them are monopolies, some of them operate in a regulated environment, some of them operate in a protected environment. They really haven't been put through the rigor of what you would normally see in an industrial company. And that brings a completely different mindset of managing that asset and improving the operational capability of that, and hence ultimately improving profitability. So the logic for owning infrastructure is improving the service. And I'm not saying that is universally the case, because some government-run assets are operated really well. The second is, as government balance sheets all over the world have got stressed, all over the world, pretty much every single large OECD country around has got deficits today. So how much can a government continue to fund growing infrastructure, existing infrastructure, upgrading infrastructure? I'm not even talking about new infrastructure. That's the second reason why assets historically have transferred from government to private ownership. So the combination of the two is the reason why it's a big growing private infrastructure community.
Sometimes corporates even need financial help. Talk about that.
A lot of times corporate needs financial help. And if you think about it, a large number of corporates are already sitting on big pieces of infrastructure within their portfolio. If you think about an oil and gas company, They want to drill for oil and gas. That's the biggest area where they spend capital expenditure on. And then to evacuate that oil and gas, they have to build a pipeline. Now, actually, it is not necessary for them to build the pipeline. Somebody else can do it for them. And as long as they have access to that pipeline, why do I need to own that pipeline? Historically, corporates have owned that. But over the last 20 years or so, corporates have realized that it's a better use of their balance sheet not to fund capital expenditure and actually spend capital expenditure where they're better off and getting a better return than owning a piece of pipe that someone else can operate. And as long as they have use for that, it makes a lot of financial sense for them. And it then makes a lot of financial sense for us and our investors who are investing in this asset class.
So that's where GIP comes in. What is GIP?
Private equity style dedicated infrastructure asset manager that focuses on 4 subsectors: investing in energy infrastructure, and energy defined for us as anything that moves oil, gas, liquids, power. The second is transportation infrastructure, which is airports, ports, rail, roads. Think about digital infrastructure, which is data centers, fiber optic cable, telecom towers, all of which is necessary to get you to download data very quickly on your phone or use AI very quickly. You need to have the data center capacity to do that. And then water and waste infrastructure, which is recycling facilities, collection, and then incineration and disposal of all of that. So that is our definition of infrastructure. And what GIP does is invest in some of the largest infrastructure assets around the world in these 4 sectors, buys them, operates them, improves their financial capability, and at the end of the day, in some cases, sell them and return capital.
How do you make investment decisions today, practically?
We start with focusing on the 4 sectors. It has to be the 4 sectors that we know, and we have built an area of expertise. So we know what to look for and where we can generate incremental value and return for our investors. So the first thing is choosing the right asset. The second thing is we are value-add investors. A number of our transactions are with corporate partners. So more than half our transactions that we've done are 50-50 joint ventures with large oil and gas companies, large utilities, transport companies. So second is making sure that you get the governance right. The third is over the life of that asset, having a plan as to what are the 4 or 5 things we're going to really do in this company to create value. Is it de-risking it from a market perspective, construction perspective? Is it growing a market? Is it adding an incremental leg to what we are doing? So have a thesis as to what are the 4 or 5 things you're going to do in the asset to improve the profitability and then execute it. But one of the things that I believe that we've done really well is at the time of investing, already thinking, how are we going to exit this investment 5, 7, 8, 10 years down the line? So we deliberate a lot as to who's going to be a logical buyer and what do we need to do to attract an investor. So those are the things that we think through very carefully. And then we have also started thinking a lot over the last 8, 9 years, how is this asset going to be positioned from a transition towards net zero over the next 10, 15, 20 years? Because one thing is very clear, that if what you own today and you don't reduce the carbon footprint of that, it's going to be very difficult to eliminate the carbon footprint for most of the assets. Over a period of time, you can, but during our lifetime of ownership, 5 to 10 years, if we can demonstrate that we're reducing the carbon footprint of that investment, we will attract more investors when we sell. So that's another area that we think through a lot as we're making a decision-making process. And then we sit through in a room, debate it at length, and then come up with a value that we want to pay for it. And sometimes we win, sometimes we don't. The worst mistake you can make is fall in love with something, pay for it a lot, and make a big mistake. So discipline is super important in how you get to a decision on an investment.
Let's talk about 2 of the frontiers, the areas where you're most active in infrastructure investing going forward. One is around the transition to a low-carbon economy, and then the second is AI and data centers. They have some overlap. Let's talk about AI and data centers.
AI and data centers is a game changer from an infrastructure perspective. I'll give you some numbers. In the last 15 years in the US, there has been no growth in power demand. And growth in power demand has been offset by efficiencies to a certain extent. So if you look at the load growth, it's been flat. With cloud computing increasing, and more importantly, with the advent of AI, the US is going to have growth in electricity is going to be 2.5% per annum. That is a massive increase in the amount of power that is going to be needed. That is a massive increase in the amount of infrastructure needed to move the power. That's just one example. You do a normal Google search and you do a AI-enabled ChatGPT search or any of those searches, the amount of power you need for that same search is 10x what you need for a Google search. So the amount of power needed is huge. For AI, again, the computing capacity that you need, the chips capacity you need, the data center build-out that you need to warehouse all the kit that enables you to do the fast computing that you want is increasing at a rate fivefold. All hyperscalers put together deployed about $230 billion in CapEx for building data centers in 2023. In 2024, that number is going to be 20%, 25% higher. That number is going to go to 500, 600, 700 billion to $1 trillion a year going forward. That has to get funded. That has to get built. And what is the infrastructure data center here? It's the building, it's the land, it's the permitting, it's the power, it's the cooling. This is not including the chips and all the stuff that needs to get put in as well. So that capacity that's going to get built in is so large that it needs to be funded. Sounds very simple, but it is extremely complicated to get the land, get the grid, get the permits, build it, cool it, because you can't afford to have a failure here, because this is 24/7. So the availability of the data center and the cooling needs to be 100%. So you're building something here which is designed to make sure that it doesn't fail. So you build backup facility after backup facility to show that if something fails, there's something else that kicks in so that all these chips remain in a cool environment.
Let's talk about the energy transition. Why is that relevant for you as an infrastructure investor?
Because the bulk of what is required for energy transition is a combination of two things. New build infrastructure that does not exist today, or repurposing existing infrastructure to make it better and resilient in the future. And the trend of decarbonization is irreversible. And the reality is you can argue whether is the world going to get to net zero by 2050 or not. But what is very clear, a lot of capital is going to flow in for the world to get very close to that target. How close? Time will tell. But that trend is there. And then private capital is a massive opportunity to build a significant piece of what is required. And we've seen this in renewables. If you thought what has happened and built in renewable capacity since 2006, so think about it this way. The amount of capital that was put into renewables in the last 10 years, double of that is going to go into renewables in the next 10. And that's just renewables without batteries. You think about adding battery because what you want ultimately is green power 24/7. We're not close to that at the moment, but you need battery, you need all different forms of storage to get to a combination where it is a much longer than 20% load factor. So that is one piece of the economy. But look, if you think about hard-to-abate sectors, steel, chemical, fertilizers, they all emit carbon. They all want to get to a point where the carbon footprint reduces. So industry has to transform its method of generation of all of these to reduce the carbon footprint, which is going to require a lot more capital to go in, which is going to require a lot of technology to go in. So the space in energy transition investment is so large. Again, it's trillions of dollars. And we talk about digitization being a $1 trillion opportunity. That is the opportunity that we have today. And I'm not even talking about creaking existing infrastructure that needs to be upgraded, which also is another big opportunity. You add all of those three together, the capital that is needed to build, repurpose, or improve existing infrastructure is so large, which cannot be funded by governments, can be funded by private sector, combination of corporate and private pool of capital, which is why the opportunity ahead of us is so large over the next 10, 20, 30 years.
Raj, you've talked about operational improvements. What does that actually mean for one of the assets you own?
Operational improvement is going inside a company, looking at how they run their day-to-day business and seeing, can we change the way they operate to make it better? And if we change the way they operate to make it better, is that going to give us a financial reward? Is that going to make her customers happy? And if actually can deliver both of that, even better. So give an example of Gatwick. We did many different things at Gatwick. Gatwick is in the UK. It's the second largest airport in the UK. It's on the outskirts of London, just outside of the M25. It is single busiest airport out of a single runway anywhere in the world. When we bought Gatwick Airport, we had a plan to increase the air traffic movement at peak time to 55. We call it the drive to 55. And what's an air traffic movement? An air traffic movement is a landing or a takeoff. So at peak time, which is early in the morning, 7:30 in the morning till about 9, when everybody wants to fly, we were doing 45 in an hour or 47 in an hour. We systematically worked on a different set of initiatives, and we had to work with the air traffic controller. We had to work with all the airlines. We have to work with the crew in the gate to turn things around quickly. As soon as the plane touched down at the runway, we had to get it off the runway that someone else could land. So this was a series of processes that we needed to think through. What's the most optimal way for the sequence of landing or a takeoff? Is it a takeoff landing? Is it a landing takeoff? So we did all this analysis. So mechanically, we worked out a process to say, if we do this, we will increase the air traffic movement at peak time. So it was that drive that ultimately led us to getting to 55. Now, why is that important? It has to be done in a safe way. So to work with the Civil Aviation Authority in the UK, the regulator, to make sure everything is fine. To work with the air traffic controller to make sure everything is done safely. But at peak time, airlines pay for capacity. So our ability to sell that extra slot that we've generated, so £1 billion of value that we created just through that one initiative, didn't happen overnight, but it needed an operational team to work very closely with everybody at the airport to drive that. That's just one example. The second is security. At an airport, when you go through security, some people get stressed because it takes a long time. You're stuck in queues and you're, at the end of it, when you come on the other side, very disgruntled. Our plan was very simple. Let's do something that can get our customers through their security lane as quickly as possible, as de-stressed an environment as we can. And you go to some of our airports, you will see how quickly we get people through the security channel. And as an airport owner, when you have got through your clients through security quickly in a de-stressed way, you've done two things. A, they're happier when they come on the other side. B, they have more dwell time. And what do people do at an airport when they have dwell time? They go and buy something. They buy a coffee, they buy a newspaper, they buy a bag, or whatever it might be. And as an airport owner, that's a positive because that you add it to your bottom line. So focusing on customer service, focusing on the processes, has led us to making our airport better, making our airlines happier too, because when we get clients through security faster, our airline customers are also happy if customers are happy. And that has generated financial reward for us and our investors. So that's just two examples that really show what we are capable of doing.
Raj Rao, thank you and welcome to BlackRock.
Thank you, Mark, for having me.
In the next episode, I'll be speaking with GIP partners Matt Harris and Salim Samaha about how the transition to a low-carbon economy is driving massive demand for new infrastructure and what this means for investors everywhere.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.